National income accounting. The first thing about national income accounting is the GDP. GDP is nothing but a value of all the final marketable goods and the services. It is the value. So we can say that GDP is the value of all. What the final marketable, it is only related to the final. The final marketable goods and services. When we are calculating the GDP, only the newly produced products, goods as well as the services are considered as the final output and no intermediate goods are considered. Which is produced with the residents of a country. It is not nationals or citizens. It is residents, right? We are not mentioning it as the nationals or the citizens. In a domestic territory in 1 year. So what is national income accounting? We are looking into the topic of national income accounting. It includes GDP, right? In GDP, we are telling that it has a value. All the final all final marketable goods and services. It includes only the newly produced, not even second time resale, newly produced only, and it does not include the intermediate goods produced by the residents are producing and not the citizens. Domestic territory. Now, what is this domestic territory? In economics, it refers to the economic territory which refers to the geographical territory administered by the government within which we have persons, goods, capital circulate freely. Domestic territory of a nation is a territory within the political frontier of the including the territorial waters, ships, aircraft which are operated across different parts of the country. Embassies, consulates, and military establishments of the countries are located in the abroad. Now, the first is the territory. This includes a territory of a within the political frontier. This territory is also having a political frontier. Territory within a political frontier, this is going to include the water as well, the territorial water as well. Then we have the ships and the aircraft which is operating across the world, right? Ships and we have the aircraft which is operating across different parts of the world. Those belongs to the domestic territory. And we have the embassies, consulates, and military establishments. Even the militaries are included over here. So we can include the embassies first, consulates, and military establishments as well of a country located in abroad. Now, GDP does not capture certain things which should not capture is the intermediate goods and resale goods. We know, right? It does not capture the intermediate goods, as well as it does not having any value over the resale goods. So we say that we have intermediate goods as well as the resale goods, right? And household services. Household services are unpaid, which are unpaid. They are not captured by the GDP. Transfer payments. Transfer payments are nothing but the like gifts, parallel economy or black money and non-monetary exchanges. Plus, it is not capturing the inequality or the externalities in the country. The externalities could be positive or negative. This is very important that it is not capturing the inequality of a country as well as the externalities. Inequality is not captured over the GDP as well as the externalities. Right. Now we know that non-monetary exchanges, non-monetary transactions, we are doing some exchange, which is not having a money value. Right. Then we say that the parallel economy or the black money and transfer payment. It's like gifts, transfer payment, and we have the household services is important. So out of the things which GDP does not capture, so let us like household services is looking important, and inequality of the country externalities transfer payments. These are very important to be remembered. GDP captures, what does GDP captures? Even if it is a self-consumed output, right? I consume for myself. This is what we call it as a self-consumed output is being captured by the GDP. So the self-consumed output is nothing but the farmer consuming his own produce, owner occupying the household services. As a rental of the tenant occupied house, housing is counted as a sale of the rental, sale of service. So housing is nothing but the services sector. Housing belongs to the sector services. Right. Now, GDP is consuming that housing services, which are owner, which is occupied, right? And self-consumed output. So it is going to consider the self-consumed and owner occupied, both the things. Now, what is the final goods? It is meant for final consumption, right? Final goods are meant for the final consumption, will not pass through any more stages of production or transformations. No further transformation is what we can get from the final goods. And example are bread, butter, biscuits used by consumer. They are used by consumer. Now, what is an intermediate good? We have something which is also called as the intermediate goods, which uses raw material and they are used as raw material or input. So, raw material is what we call it as the intermediate good. They are used as raw material or they are used as the inputs. This is for production of other commodities. They are used for the production of other commodities. Example, wheat flour is an intermediate good, right? In the production of the bread bakery. From the wheat, bread, this is an intermediate good. Whether a good is a final good or intermediate good, it depends on its use, right? For example, the same bread again, I can use it for making, I can use it in the hotel for making another dish, right? That is how it depends on its use. Whether a good is, we say that whether a good is final or intermediate, it depends on the use. Good, which is final or intermediate, depends on its use. When we use milk for sweet, it becomes an intermediate good. But when it is used by the consumer, it becomes a final good. We have seen 5 topics so far. Now, first, what is a GDP? We have seen what is a GDP, right? GDP is all final marketable goods and services, right? So it is going to include all and then the final goods and the services. Only the newly produced goods and the services are considered as final goods. What is a final good is an explanation. So we need to tell that it is all final goods, right? What is a final good and does not include an intermediate good. Then produced by residents of a country. Residents of the country. What is a domestic territory? Economic territory, geographical territory administered by the government, within which we have persons, goods, and capital circulate freely. It is including three types. The territories within the political frontier, including the territorial waters of the country. The ships and aircrafts operated by residents of the country across different parts of the world, right? Embassies, consulates, and military establishments of the country located abroad. Does not capture, we say intermediate goods, goods from the resale, household services, transfer payment, parallel economy or the black money, non-monetary exchanges, as well as inequalities and externalities. Captures self-consumed output and owner-occupied housing services. Final goods meant for final consumption. Intermediate goods or raw materials or inputs for the production of other commodities. What is the problem of double counting? Intermediate goods are not included in the calculation of the national income. Only the final goods are used for the calculation of the national income because the value of the intermediate goods is already included in the value of final goods. The double counting we need to mention about the intermediate goods whose value is mentioned in the final goods as well. So you count two times. If you count the intermediate goods as such, the value is mentioned in the final good as well. So it looks like a double counting. That is why we are not including the intermediate goods. To avoid the problem of double counting. What is the problem of double counting? We have the intermediate good. It is not counted, not included, right? Not included in the calculation of the national income. The final goods alone are included in the calculation because the value of the intermediate good is already included in the value of the final good. Now, what is a transfer payment? We have something called as a transfer payment, right? Unisided payments, everything which are transfer payments are unisided. One-sided payments are transfer payments made by the government. Especially we are speaking here about government your transfer payments made by the government to the individuals with no economic activity. It is having no economic activity. So how do we state that? It is a one-sided or unisided payments. So in GDP, we are considering the transfer payments which the government is making to the individuals. Government to the individuals is what we consider in the GDP. There is no economic activity. It is having no economic activity, right? And it is produced in return by these individuals. No economic activity is produced in return by the individuals. Example, we have the scholarships and the pension. Scholarship and pension are the examples for unisided payments, right? We know what is transfer payment. And types of GDP is the nominal GDP and the real GDP is base year. RCB, real GDP base year. Real GDP base year, right? Nominal GDP. Now, what is nominal GDP? The current year production of goods and services valued at the current year prices. Current year production of the final goods and services which are valued at base year prices. It is clearly mentioned, right? Current year base year. So the current year production of the final goods and services valued at current year prices. Now we'll be having the current year production of final goods and services. It is valued at even the current year prices. Current year final goods and services are valued at current year prices, right? So the current year is what we'll be having the nominal GDP. It is what we have the nominal GDP. Now what is real GDP? The same thing. The current year production of similar, the final only we have to mention. The final goods and services, you can say it is calculated. Calculated at the base year prices. Right. Representation of the economy is more of estimation. It is representation of the real economy. Estimation of the economy, real economy. You say that it is representation of a real economy. Estimation. You need to have the estimation of the economy. Now, what is inflation? Effects of inflation is taken into account and effect of inflation is factored out. So the inflation is taken into account over the current GDP. Current, it is what we call it as a nominal GDP. The effect of inflation is being removed in the real GDP. Implications is increase in the nominal GDP does not imply production of the goods and services as it may be due to general price rise. Increase in the real GDP, it implies a necessary increase in the production of the goods and services better indicated than the nominal GDP. So who is a better indicator? Here. This is a better indicator than the nominal GDP. Increase in the nominal GDP, it does not imply the production of the goods and the services as it may be due to general price rise, right? Increase may be due to the general price rise. General price rise is inflation. What is a base year? Year used at the beginning or the reference year for constructing an index and which is assigned an arbitrary value of 100. The value of the base year is 100, right? What is a base year? It's a year used as a beginning or a reference year. So this is a starting year. That is what we call it as the beginning year or the reference year, right? So this is the beginning year or the reference year. This is for constructing an index. You need to construct an index with it. It is assigned a value of 100. Assign the arbitrary random value. It's a random value of 100 because it is a beginning year or it is a reference year, right? Beginning year or a reference year. And the value is 100. It is for constructing an index. The estimates at the prevailing prices of the current year are termed as current prices, and those prepared at the base years are termed as the constant prices. So when we are having an estimate at current year, they are known as the current prices. But whenever we are doing an estimate at the base year, it is not known as base prices, it is known as the constant prices. We have it as a constant prices, right? It is changed periodically to take into account the structural changes which takes place in the economy and to depict the true picture of the economy. We have the structural changes which are taken into account. So the structural changes are taken into account over here. A base year has to be a normal year without large fluctuations in the production, trade and prices of the commodities in general. Reliable price data should be available. We say that for the base year must have a reliable data without large fluctuations. It is not having any large fluctuations, right? Trade and prices of the commodities should be as recent as possible. It must be a recent one. Revision of the base year generally shows an upward revision of the GDP calculation due to the inclusion of the new goods and services. We are having new goods and services which is revisioned, right? Market price, and then we have the factor cost. Now we know what is a market price. Actual transacted price, and it includes indirect taxes, not a direct taxes, and customs duty GST excludes the subsidies. And factor cost. Now what is a market price? It refers the actual transacted price, right? So we have an actual price. Actual price, and it includes the indirect taxes and not the direct taxes. Why it includes indirect taxes, right? Indirect taxes means when a product is coming in the market, that product is taxed. Direct taxes when the people are directly taxed income for their income or corporate tax. Those are known as the indirect taxes. So direct taxes. Indirect taxes means when the product is taxed. So the final MRP, if we are buying a biscuit, it is rupees 10. The production cost will be like rupees 6 or even rupees 10. But the government gave subsidies, so in total it is 8 rupees. But again the government has taxed it to become 10 rupees again. So this 2 rupees burden is on the people. The subsidies reduce the burden of the companies. Now we have the market price and the factor cost, right? So market price here is the actual transacted price. What is the price in which it is available is what we call it as the market price. The price at what price it is available. Is what we call it as the market price. right? Now, the actual transacted price. We say it as the actual price. Actual transacted price. It includes indirect taxes. Exclude the subsidies. Government role is excluded from it, right? Excludes the subsidies. Now, here, if it is 10 rupees, 8 rupees is a subsidy, but tax it is 10 rupees means this 8 rupees subsidy is being excluded. 2 rupees is the tax, so it is considered as 12 rupees because subsidies are excluded from it. We add subsidies, subsidies are removed from it. We are not considering subsidies, right? That is what we say it as a market price. Market price is going to include indirect taxes, excludes subsidies. Now, what is a factor cost? Factor cost refers to the actual cost of various factors of production, and it includes the factors of production includes the government subsidies, grants and subsidies, but excludes the indirect taxes. Just opposite to the market price is the factor cost. At the market only we are having the taxes, right? So this is just an opposite of the market price. Factor cost refers to the actual cost. This is the actual cost of various factors of production. We have various factors of production. And it includes the government grants. It includes government grants and we also include the subsidies. But not indirect taxes. So the indirect taxes are being excluded from it. Example, market price minus the indirect taxes plus the subsidies is what we have the factor cost. Market price minus subsidies, minus indirect tax plus subsidies. Selling of a Maggi by Nestle through mixing of the wheat flour and spices is value addition. Now first, now we are revising as well. Once we complete 5, we are revising. Now what is the problem of double counting? The intermediate goods are not included is what we say it as a double counting. We have intermediate goods, right? Those are not included in the calculation of the national income. Only the final goods are included in the calculation of the national income because value of the intermediate good is already included in the value of the final good. What is a transfer payment? The unisided payments by the government to the individuals which is having no economic activity like the scholarship and pension. Nominal GDP, the current year production. Real GDP is also the current year production of the final goods. At current year prices, at the base year prices. It is an estimation of the economy, real economy. Inflation is taken into consideration and inflation is factored out. Increase does not imply the production of goods and services. It may be due to the general price rise. Increase implies the necessary increase in the production of the goods and the services. It is a better indicator than the nominal GDP. Right. What is a base year? The year used at the beginning or a reference year for constructing an index. Using the base year, we are making an index, right? Which is usually assigned as an arbitrary value of 100. So the base year is having a value of 100. The estimates are prevailing prices of current year termed as the current prices, while those prepared at the base year prices are termed as the constant prices. So we have here two terms. the current prices versus the constant prices. Changes periodically to be taken into account to the structural changes which take place in the economy and to depict the true picture of the economy. Base year has to be a normal year without large fluctuations. There is no large fluctuations in the base year in production, trade and prices of the commodities in general. It is having a reliable price data and it should be available for it. It should be as recent as possible, and a revision of the base year is generally shows an upward revision of the GDP calculation due to inclusion of we have new goods and services, right? Now, what is the market and factor cost? We know market price is nothing but the final output. It is including the indirect taxes, but it is excluding the subsidies. Now, we have the factor cost is the final output, which is not considering the factor cost, which is not considering the indirect taxes, but it is adding the subsidies. So indirect taxes is not considered. From the market price, we remove the indirect taxes plus the subsidies. We have seen GDP. Now we have to see GNP. Gross National Product. Nationals of a country. Right. See, it is simple, right? Gross national product is only by the nationals of one country in 1 year. Nationals of one country in 1 year. Gross national product is the nationals of one country in 1 year. Now we say GDP plus the net factor income from abroad is exports minus imports. Net factor income is exports minus imports plus the net factor income abroad, right? Gross national product is the value of all the final goods and services. So the value of all the, we say it as a final goods and services. All the final goods and the services. It is produced by the nationals of one country in 1 year. One country in 1 year. GNP is GDP plus the net factor income from abroad. Net factor income from abroad. GNP versus GDP. Honda manufactured cars in the US, but it is incorporated in Japan. The car it produces in the US are added to the US GDP, but not in the US GNP, as the cars are used domestic factors of the production like the labors and resources, but are produced by a foreign nation. Conversely, the values are added in the Japan's GNP, but not in the Japan's GDP. Understood? Net factor income abroad. So first we are discussing the GNP is equal to GDP plus the net factor income abroad. So we have discussed what is GNP is the final value of the goods and the services. All the final value of the goods and the services produced by nationals of one country in 1 year, right? Net factor income abroad is nothing but the exports. We have exports minus the imports. Income received by the abroad from the abroad by a normal resident of the India for rendering services in other countries. The income paid to the foreign residents for the services rendered by them. I am in India. I export something and I get money back. So the income received from the abroad. This is the income is received from the abroad by he is a normal resident of India, right? For what? For rendering some services. Right. We say that the income is received from where? From abroad. The income is for rendering the services. Right. We get income from abroad for rendering the services. This income is received by the normal residents of the India. Right. The normal residents are receiving the income by the normal residents of India. Net factor income from abroad should not be confused with the income from the net exports, which are part of both the GNP and then the GDP. Exports minus imports is what we have the net factor income from abroad, right? And income which is paid to the foreign residents of for the services rendered by them is being subtracted, right? The foreign residents, the income which they receive. Now, net exports is a part of GNP and GDP. Net imports is only a part of the GNP, not GDP, right? That is why net factor income abroad is not confused with the net exports. Now we have a relationship between GDP versus GNP. GDP, when it is equal to the GNP, it is a closed economy where GDP is equal to GNP. GNP is equal to GDP plus net factor income abroad. This is zero, right? It means that no exports, no imports. Therefore, it is a closed economy. Closed economy means no exports, no imports. And nobody leaves its shores. We have nobody leaves. Nobody invests abroad. No investment abroad. And nobody comes in and nobody invests in the country. Now, when GDP is greater than GNP, GNP is lesser. GDP plus net factor income abroad. Now, if GDP is 10 and this is minus 1, 10 minus 1 is 9. So this is 10 and this is 9. What does minus means? We have more imports than exports. Open economy with great levels of foreign investment and lesser levels of outbound GDP. More is coming here. Input is more, but export is less, right? So we can also say it as when GDP is high in terms of GDP, right? GDP is right when we say it as a greater level of, we say it as a greater level of foreign investment. The foreign investment is FDI, right? So there is a greater level of the foreign investment, which is FDI, and lesser level of the outbound FDI. Lesser FDI, outbound. When GDP is lesser than GNP, we have to tell it as lesser level of foreign investment. Whereas we say it as a greater level of FDI outbound. Open economy, but most of its nations tend to move the economic activity abroad and earn more from investing abroad company with non-nationals doing business or earning the income within its borders. Right. Now, what is the open economy? And we have to read about the closed economy. It is the monetary value of the finished goods and services produced by the country citizens is the net national product. We are seeing the net national product. Okay. Now here first we have to get the open economy and closed economy. This box must come up somewhere. And here we have a net national product. Over here we have it is having a continuation. This box has been inserted over here. So let us see the box first. What is the open economy? Which has economic relations with the rest of the world. What kind of relation? We say we have economic relations. This economic relations is with rest of world. We have economic relations with rest of the world. But in most of the countries are open economy. But what is a closed economy? No economic relations with the rest of the world. Closed economy is difficult to find, but like North Korea could be an example for it. No economic relation. We say it as a economic relation with rest of the world. Right. There is no economic relation with the rest of the world. Representation in the economy. In the open economy, the demand for the domestic goods is equal to the domestic demand for the goods. Consumption, investment, government spending, plus exports minus imports. Here GDP is equal to GNP, but in open economy, we can say it is varying. In open economy, exports constitute an additional source of demand for the goods and the services. Right. Next thing we are going to see is GNP. Is the monetary value, money value of finished goods and services produced by the citizens overseas and domestically in a given period. NNP is equal to GNP minus the depreciation. We have depreciation added to it. Right. It is the value, monetary value. We say them as a monetary value. Monetary value of the finished goods and services. So we call it as we have the finished goods as well as the services, right? So the finished goods and services are produced by the country's citizens. The citizens are producing it. What we have to exclude this box. Now, depreciation is the decline in the asset value. The asset value is being reduced in the depreciation, right? Over time due to the wear and the tear. This is over time and this is due to wear and tear. National income is equal to NNP at the factor cost. Even this net national product at factor cost. We know net national product is GNP minus depreciation. Factor cost is nothing but it subtracts the indirect taxes and add the subsidies. Is what the factor cost is. So what is the national income? Is NNP at factor cost. What is the per capita income? Per capita income is also known as the income per person. We have income per person is what we call it as a per capita income. Of one person is what we call it as the income per person. That is a mean income. We are taking an average over here. Therefore, we say it as a mean income. Right. Mean income of people in an economic unit such as a country or a city. Therefore, we tell the per capita income as a mean income. Income per person. When we divide NNP is divided by the population, we get per capita income. We are using net national product for calculation of per capita income, right? So we say here that when we use NNP, when we divide NNP by the total population of a nation, NNP and the total population of the nation, we get per capita income of the nation, that is the income per head per person, per year, sorry. Now, five things to be revised. Gross national product, right? We'll be having what is the gross national product? Gross in the sense only the national. The citizens who are residing in the country plus they are residing abroad as well, right? Value of the goods produced by the nationals. Therefore, GDP plus net fractional income. We have seen the example over here. And net factor income abroad must not be confused with the net exports because net exports is included in both the GNP as well as the GDP. In GNP, we are just subtracting it with the net imports. Difference, we say it as a difference, right? It is a difference between income is received from abroad by normal residents of India for rendering services in other countries and income paid in the foreign residents for services which are rendered by them in India. Net factor income from abroad should not be confused with the net income from the net exports which are part of both the GNP as well as GDP. We have seen various cases. When it is equal, it is a closed economy. When GDP is greater, we have greater FDI and lesser FDI outbound. Reverse, this is also reverse. NNP is nothing but the finished goods and services produced by the citizens overseas in a given period of time. NNP is GNP minus depreciation. And it is depreciation is a decline in the value of the assets. National income is the NNP at the factor cost. Per capita income is the income per person. It is the mean income of the people of each economic unit such as a country or the city. When calculating, we divide NNP by the total population of the country. We get the per capita income. For calculation also here we are using NNP. Now here the 17th one is what we have, the open economy versus a closed economy, which we have previously seen the table has been misplaced. Now net domestic product. What is NMP? GDP minus depreciation is what? GDP minus depreciation. Depreciation is the wear and tear. NDP is GDP calculated by adjusting the value of depreciation. So we say that the GDP is calculated by adjusting the value of depreciation. NDP is equal to GDP minus the depreciation, right? NDP of an economy is always lower than the GDP as depreciation can never be reduced to zero. Depreciation can never be zero. So we say that NDP is always lower than the GDP, right? Because the depreciation cannot be lower to zero. Measures of the GDP, we have value added method, income method, and expenditure method. Right. So three methods. The first is the value which is being added. Right. Value added method, income. And then we have the expenditure. Value added, income, and then we have the expenditure. So these are the three methods, the value added, income, expenditure. Expenditure. Now what is value added? The net value added by all the producing units. The value is added by the producing units is what we call it as a net value added method. It's a net value added by all the producing units. Net value. It is a net value which is added by all producing units. Right. Then we have the income method. It is the sum of all the factor incomes measured. Sum of all the factor income measured. Next we have the expenditure method. It is sum of all the final expenditure which is measured. Sum of all the factor income. Sum of all the final expenditure. Right. Income, and then we will be having the expenditure. Sum of all the income. And sum of all the items final expenditure. Income method, and then we have the expenditure method. The value added method is the net value added by producing the producing units. So in value added we are having the producing units, and in the income method we are using the factor income, and in the expenditure methods all items the final expenditure. Now what are considered in the expenditure method? Expenditure method is having 4 components: consumption expenditure, investment expenditure, government expenditure. Investment, government, consumption. Right. You are doing some consumption plus the net factor income abroad. The net factor income abroad is exports minus the imports. So what is the first we are seeing the expenditure is the consumption expenditure plus income expenditure plus the government expenditure plus net factor income abroad is exports minus the imports is what we have the net factor income abroad. What is consumption expenditure? Expenditure by the households on perishable and non-perishable goods and services. We have certain expenditure by the households, and this is on the perishable, and then we have non-perishable goods and services. We have the perishable, right, as well as we have the non-perishable. In those perishable and non-perishable, we are doing certain expenditure. This expenditure is by household. So we have 3 methods. The first one is income method, expenditure method, and value added method. So value added method, income method, and then we have the expenditure method, right? So we are seeing the expenditure method. It is having 4 components. The expenditure method is having the 4 components, right? The first one is the consumption, and the second one is the investment. Investment refers to the fixed investment by the businesses. The business is doing certain fixed investment, inventory investment by the businesses, and residential investment by the households. Fixed investment, inventory investment, and residential investment by the household. Now what is a government expenditure? We all know. And net income is nothing but a net exports minus imports. So the GDP is equal to consumption expenditure plus income expenditure plus government expenditure plus the net factor income abroad. This exports minus imports where consumption, so net exports. Then what is the income method? We are taking into consideration the income of all the factors of production in the economy for providing the factor services. Income of all the factors of production. So this is what we'll be having the income method. Is the income. We have the income of all the factors of production. Now, what is the factors of production? Is the sum of all the factor income is the land, we have the labor. Sorry, land, we have the rent. Land, we have the rent. For labor, we are giving wages. For capital, there is an interest. And for enterprise, we have the profit. National income at factor cost. We have the national income, right? The national income at factor cost is what we call it as the NNP at factor cost. Plus net factor income from non-domestic, that is from abroad. Income method is having the NNP plus NX, income abroad, right? Net factor income plus abroad is what we have. The income method is NNP. There are 4 types of incomes, right? They are rent, wages, interest and profit. Rent, wages, interest and profit. We have to tell this alone. So rent, wages, interest and then we have the profit. National income at factor cost. NNP plus the net factor income. What is the national income at a factor cost? NNP at factor cost plus net income from non-domestic, that is from abroad. This is national income at factor cost. National income is equal to NNP at factor cost. National income even at the factor cost is NNP plus the net exports. Included all the factors of income which is generated via production of the goods and services, wages, rents, profits, GDP by the factor income. Exclusion in the sense it is a transfer payment is excluded. Social welfare, dole payments and state pension etc. Transfer, private money transfers, black shadow economy, unrecorded income from unofficial sources is criminals. Value added method, right? The definition of value added is difference between the cost of the inputs to the production, price of the output at a particular state of the production, in overall production processes. The sectoral classification provides data on 8 broad categories that span the gamut of goods produced and services provided in the economy. Now, here we say that agriculture and allied services, mining, manufacturing, construction, electricity, gas and water supply, banking and insurance, public administration and defense, real estate, transportation, communication and trade. These are the services which are included over here, right? Now, what is the recent changes? Official GDP, headline growth rate will now be measured as GDP at the constant price, market prices from GDP at factor cost at constant prices. Revision of the cost price. NSO has revised the national account statistics in January 2015 and it was declared that sector-wise estimates of gross value addition will now be at the basic prices instead of factor cost. Change the base year from 2004-5 to 2011-12. Improve the coverage of financial corporations by including stock brokers, stock exchanges, assets management companies, mutual funds, pension funds, as well as regulatory bodies, SEBI, PF regulatories and insurance regulatories. Changes in the calculation of agriculture income. Livestock is considered. Shift from establishment approach to enterprise approach. Establishment approach used in the annual survey of the industries does not capture the activities of unit other than manufacturing. Now, in new approach, the activities of manufacturing companies other than the manufacturing are accounted. In the manufacturing sectors, these changes possibly have increased the coverage of registered sector of manufacturing. The enterprise approach is facilitated by MCA 21 with Ministry of Corporate Affairs. Incorporation of finding of NSSO surveys. The updates are an improvement in the representation of activities in the unorganized manufacturing sector. The change in the labor input method. The new series have switched over to effective labor input method for unincorporated manufacturing and services enterprises. Earlier was assigning equal weightage to all types of the workers, while the new method assigns different weightage for workers as per their productivity. Change in the calculation of the methodology. GVA at the base prices is equal to compensation of employees plus operating surplus mixed income plus consumption of fixed capital. Now, production tax for production subsidies, we know product tax, product subsidies. During the process of the production, that is in the factory, when there is a tax for the factory, for the raw materials, for the electricity, etc., and production subsidies we are giving for the land, for the capital when it is taxes are provided, it is production tax, and for the capital when there are subsidies, it is production subsidies, right? The paid or received in relation to the production and are independent of the volume of actual production. Land revenue, stamps and registration fees are example for it. Now they are paid or received as per unit of production. Excise, imports, even GST. Imports, exports, GST. What is a GDP deflator? GDP deflator is nothing but the nominal GDP which is divided by the real GDP into 100. Right. Nominal GDP divided by the real GDP into 100. It covers the whole economy and not based on the fixed baskets. Is the importance of GDP deflator. So GDP deflator is a price deflator to determine the level of the prices in the newly domestically produced final goods and the services. We are excluding the inflation over here. So nominal GDP minus the real GDP is how much the GDP is deflected because of the effect of inflation is what the GDP deflator. What is gross national disposable income? We have something known as the disposable income. Now, the disposable income means the gross national disposable income. It measures the income which is available to the nation for final consumption and saving. The income which is for the finally I am going to consume. So, the income which is for the final consumption and the saving is what we call it as the gross national disposable income. So, we call such an income as a disposable income. The income which is available for the final consumption and in the saving. It is for the final consumption as well as it is for the saving is what we have the gross national disposable income. It includes both the earned income and the transfer income is the unearned income. So what is an unearned income? The transfer income is what we call it as the unearned. We didn't earn it. So unearned income is nothing but a transfer income. Formula. Gross national disposable income may be derived from the gross national income by adding all the current transfers is the remittances. By adding all the transfers which is called as the remittances, social contribution, gifts, aid, etc. receivable by resident from the non-resident. Resident is receiving from a non-resident is what here the transfer payments are included over here. Previously in the gross national income, in GDP, we included a transfer payments of government alone. In GDP, the transfer payment of the government transfer payment alone is included over here. But in the gross national disposable income, in the gross national disposable income, We are including the transfer payments which is received by a resident from non-resident and subtracting all the current transfer payable by resident to non-resident. Incoming payments are added and outgoing transfer payments are subtracted in the gross national disposable income. Right. So what is a gross national disposable income? Measures the income which is available to a nation. So we say that the income is available to a nation. It is for the final consumption and it is also for the saving. Final consumption. We do final consumption with the income and then we also do the saving. Final consumption and then you also do the saving. Such an income is a earned income. You earn it, right? Earned income. And we also have the transfer income. There's an unearned income. So the formula is going to be the gross national disposable income may be derived from the gross national income. By adding all the current transfers, remittances are added, social contributions are added, gifts, aids are added. They are receivable by the student from non-resident and subtracting all the transfer incomes, transfer payable to by the resident to the non-resident. And what is a personal income? Personal income is a part of the national income. Personal income. So we say that the personal income, it is a part of the national income which is received by the households, right? The national income, the income which is received by the households is what we can call it as a personal income. Formula for the personal income is national income minus undistributed profits, savings of the firms plus the interest payments made by the households. So from the national income, if you are undistributed profits, the firms are not the certain amount of profits which the firms didn't distribute. So the profits which the firms didn't distribute. The firms which they didn't distribute, right? The profits which they didn't distribute plus the net interest payment. We call it as an interest payment. You pay interest made by the households are making a interest, right? This interest is also included in the personal income. That is through their income alone, it is subtracted, right? The personal income interest payments is subtracted and corporate, even the tax is being subtracted of the corporate plus the transfer payments to the household from the governments and the firms is what we have the personal income. First, we have to subtract from the national income. How to arrive personal income from the national income? So personal income is arrived from the national income by subtracting profits, undistributed profits of the firms. And then we have interest payment of the households. We have to again subtract the corporate tax. So the undistributed profits, the corporate tax and the interest payments. We have to add the transfer payments made to the households from the government services. Now what is a personal disposable income? Is that part of the aggregate income which belongs to the households, right? Now if I have 100 rupees as an income, 20 rupees is compulsory interest payment. I cannot use this 20 rupees for no sake. Right, balance 80 rupees is what we have the disposable income. So that is what is calculated in the personal income as well. It is an aggregate income which belongs to the households. We have the aggregate income. So it is an income which belongs to the households. They may decide to consume a part of it and save it rest. So it is used for the consumption as well as savings. It is used for the consumption as well as the savings. This is what we call it as a personal disposable income. It's a part of the aggregate income. So it is a part of the income which belongs to the households. So the income which the households add. What is a personal income? Minus the tax payments. You have to subtract the tax as well. I pay the tax, right? So the tax is subtracted and non-tax payment is also subtracted for the personal disposable income. When in the personal income, we are subtracting the undistributed profits from the national income and corporate tax of the corporates, right? Then we are also subtracting it from the net interest payments made by the households, and we are adding the transfer payments made to the households from the government and the firms. What is a potential GDP? Also known as full employment GDP, right? Potential GDP is the full employment GDP. It refers to the level of real GDP of an economy when can produce what when all its resources are fully utilized. When potential GDP is all resources, when completely it is fully utilized. When you are giving 100%, what is the GDP for 100%? Right? It is also known as full employment GDP. So potential GDP is also known as the full employment GDP. Potential GDP, full employment GDP. Right? It is the level of real GDP and economy can produce. The real GDP and economy is producing when all of its resources are fully utilized. When all the resources, we say all the resources are fully utilized. It includes the labor, capital, technology while maintaining a stable inflation. It maintains a stable inflation, right? It can change over the time and factors such as the population growth, changes in the labor force participation rates, and technology advancements, improvement in the productivity can influence the economy's potential output. So what is a potential GDP? Is the full employment GDP. 100% when all the labor resources are utilized, a complete capital is utilized, and 100% technology and stable inflation. We are land, labor, capital, technology as well as the mention of inflation. It can change over the time. So it is changing over the time and the factors of the production such as the population growth. Population growth and changes in the labor force participation rates. Technological advancements and improvements in the productivity can influence the economy's potential output. What is a saving? Saving represents a part of the disposable income that is not spent in the final consumption of the goods and services. Zero savings means everything, the final consumption expenditure is equal to the disposable income. Right. For example, in a closed economy, savings equals a capital formation during the year, whereas in the open economy, savings equals to the capital formation plus the net capital inflow from the abroad during the year. Savings is equal to the capital formation in a closed economy, because when we are saving in the bank is going to give it as a loan for the capital expenditure of companies, capital investment of the companies. That is how we say that the savings is equal to, we say that the savings is equal to capital expenditure, capital formation, right? Whereas in an open economy, the savings is equal to capital formation plus we have FDI, foreign direct investments. The foreign direct investments are also added over here. What is gross domestic saving? Consists of household savings, private corporate savings, and public sector savings. Households are saving, private sector is saving, as well as the public sector is saving. Now, revision of the last 5 topics. What is the gross national disposable income? Is the income and then personal income, right? Disposable income, which is used for the consumption and saving. So the keyword for the disposable income is consumption. We are using it for the consumption and we are saving it as well. Consumption and then we have the saving. Consumption and saving is what we have, the gross disposable national disposable income. So gross national disposable income is nothing but the consumption plus the savings. It includes the earned income as well as the transfer income is the unearned income. So what is a transfer income? The transfer income is nothing but unearned income. Formula for this is gross national disposable income may be derived from the gross national income by adding all the current transfers. National income plus the transfers receivable by the residents and subtracting all the transfers. The gross national disposable income is derived from the national income. The gross national income adding all the current transfers. We have to add all the current transfers and then we are subtracting the current transfers payable by the residents. Now, what is a personal income? Which is received by the households, right? Personal income again we are bringing from the national income. National income plus or minus the transfers is what we have the gross national disposable income. Right. Now, when we are going from the personal income, national income minus the undistributed profits of the corporates and firms plus the corporate tax minus the interest payments by the households plus transfer payments to the households from the government and firms. What is the personal disposable income? Which they are decided to consume and save is what we have the personal disposable income is minus the personal tax payments minus you are subtracting the tax and non-tax payments from the personal income because only the taxes are subtracted and then the remaining amount is being credited. Potential GDP is the full GDP, full employment GDP. It refers to the level of real GDP of an economy which produce when all its resources are fully utilized. It includes the labor, capital, technology, while it maintains a stable inflation. It can change. We say that this is changing over time. Factors such as the population growth, changes in the labor force participation rates, technological advancements, and improvements in its productivity can influence the economy's potential output. What is saving? Saving represents that part of the disposable income that is not spent on the final consumption of the goods and the services. That part which is not spent is saved, right? Zero savings means everything is consumed. Savings is equal to the capital formation in a closed economies and capital formation plus the net capital inflow in a open economy. We say what is gross domestic savings is going to consist of the household savings, private corporate savings, and public sector savings. What is a paradox of thrift? Popularized by the renowned economist John Maynard Keynes, it states that individuals, paradox of thrift is nothing but when individuals are saving a lot instead of they are investing. Therefore, during an economic recession, which essentially leads to the fall in the aggregate demand and hence in the economic growth, right? Now, what is paradox of thrift? It is proposed by John Maynard Keynes. When individuals try to save more, that too during an economic recession. The individuals are saving during a recession, right? Which essentially leads to the fall in the demand. There is a fall in the demand and hence we have in the economic growth, it is causing more recession because the demand is being lowered as the individuals are investing. Such a situation is harmful for everybody. This situation is harmful for everybody as investments gives low returns than normals. Therefore, this theory is heavily criticized by the non-Keynesian economists on the ground that increase in the savings can lead to more lending. But even though if they are investing in capital, there is no demand, right? When people save more during an economic recession, there is a less demand. Therefore, the companies give less salary to the individuals. Their saving level is going to reduce. Again, it is going to lead to a greater economic recession is what the paradox of thrift. Flow variables. Concepts that are defined over a period of that time is flow variables. Stock variables are concepts which are defined at a particular point of the time. Example, buildings, machines, etc. Potential output. The level of the output that economy can affect without stoking inflation or deflation. Without inflation or deflation, what is achieved is what we call it as the potential output. The level of output which the economy can attain. The output which the economy is attaining without the stoking inflation or deflation. Output and economy attains. This output is without inflation and deflation. Output and economy attains without the inflation or deflation is what we call it as the potential output. Difference between potential and actual output is referred to as the output gap. Potential output and the actual output is what we call it as the output gap. A positive output gap occurs when actual output is more than the full capacity output. Negative in the sense when actual output is less than the economy could produce the full capital output. Now actually this is a summary, right? Now when we are looking from this, we know what is paradox of the flow variables, stock variables, and what is the potential output without the stoking inflation or deflation. A positive is when the potential output is lesser and the actual output is more. Output gap, right? Limitations is its inequalities and does not consider a sustainable growth. Limited focus on growth than development. Simplistic approach to measure standard of living. What is a green GDP? It's an attempt by the economists to measure the growth of the economy compared to the harm caused to the environment. Growth versus harm is what we call it as a green GDP, right? The growth compared to the harm. For green GDP, we have to focus on the sustainable development and ecological balance. For ecological balance, monetization of the loss of biodiversity is having a value, accounting for the cost due to the climate change, subtracting resource depletion and environmental degradation. Gross national happiness is when in Bhutan in 2008, and there are 4 pillars. First, environment is conserved. Sustainability. Sustainability includes the environment. So, sustainability includes the environment. Good governance and culture. Good governance, culture are the factors of the gross national happiness. So, what are the factors of gross national happiness? It is adopted by Bhutan in 2008. It is having 4 pillars when we have sustainability and environmental conservation, culture and governance. Business cycle, right? Business cycle and financial cycle. So, what is a business cycle? Rise in the fall in the aggregate economic activity over a period of time and can be measured using the real GDP data because inflation is removed from the business cycle. So what is a business cycle? It is nothing but a rise, and then we also have the fall. Rise and the fall in the economic activity. Economic activity. Rise and then we have the fall in the economic activity over a period of the time and can be measured using the real GDP data. And it is measured using the real GDP data. Rise and the fall in the aggregate economic activity. The financial cycle maps out the expansions and contradictions in the financial activities. Financial cycle is not observed directly. Instead, it is extracted from appropriate macro financial variables such as credit to GDP ratio, equity prices, housing prices. So we have expansion, recession, depression, recovery, peak. Expansion and first it is expanding. Recession, going down. And it is even down, it is depression. Recession, depression, expansion, recession, depression, recovery. Expand, recess, depression, recovery. This is what business cycle is. The shapes of the recovery is V-shaped recovery. Economy recovers but activity is permanently lost. Lower than V. Longer than the V shape. Faster than the U shape. U shape, swash, Z shape. is where spending surge fuels the GDP above the pre-crisis level. W shape and L shape. Economy is never fully recovered. And in W, we say that economy lifted, but the GDP suffers more cases of paralyzed economy.